The shell company. Money laundering exists because cash generated through criminal activity cannot simply be deposited into a bank account without triggering questions that no criminal wants to answer. The shell company is the oldest and most widely used solution to that problem, and it has survived decades of regulatory tightening because its fundamental architecture is almost elegant in its simplicity. A shell company is a legally registered business entity that exists on paper, holds bank accounts, and can send and receive money, but conducts no actual business, employs no actual workers, and produces no actual product or service. Criminal organizations use them to receive illicit funds as apparent business revenue, creating a paper trail that makes dirty money appear to have a legitimate commercial origin. The money enters the shell as supposed payment for consulting services, licensing fees, or goods that were never delivered, and exits the other side looking clean. The most sophisticated operators stack multiple shells across multiple jurisdictions. A payment moves from a company in one country to a related company in a second country to a final destination in a third, with each layer adding complexity that investigators must peel back one at a time, often across legal systems that do not cooperate efficiently with each other. The British Virgin Islands, Panama, and Delaware have historically been among the most popular jurisdictions for shell company registration due to their minimal disclosure requirements. The Panama Papers leak of 2016, which exposed 11.5 million documents from a single law firm, reveals shell company structures connecting politicians, oligarchs, and criminals across over 200 countries. The real estate method. Real estate is the preferred laundering vehicle of serious criminal money for reasons that are straightforward once you understand the mechanics. Property transactions involve large sums, are socially legitimate, generate no ongoing scrutiny once completed, and in many markets have historically appreciated in value, meaning the criminal not only cleans the money but profits from doing so. The method works by purchasing property with illicit cash, often through shell companies or nominee buyers to obscure the true owner, holding the asset for a period and then selling it through the legitimate market, producing clean proceeds that can be freely deposited, invested, or spent. In markets with high demand and limited supply, like London, Miami, Vancouver, and Sydney, criminal money flowing into real estate has contributed directly to price inflation that has priced ordinary residents out of their own cities. A 2015 New York Times investigation found that more than half of all residential property purchases above $5 million in the United States were made by shell companies, with the true beneficial owners unknown. The United Arab Emirates, and Dubai specifically, became one of the world's most significant real estate laundering destinations in the 2000s. A market with minimal ownership, transparency requirements, high international demand, and a government historically reluctant to cooperate with foreign financial investigations. Estimates of criminal money flowing through global real estate annually run into the hundreds of billions of dollars. The smurfing method. Smurfing, also known as structuring, is the method that criminal organizations use when they need to deposit large amounts of physical cash into the banking system without triggering the automatic reporting requirements that banks are legally obligated to follow above certain transaction thresholds. In the United States, banks are required to file a currency transaction report for any cash deposit exceeding $10,000. The smurfing solution is straightforward. Break the large sum into multiple smaller deposits, each below the reporting threshold, and distribute those deposits across multiple accounts, multiple banks, and multiple geographic locations using multiple individuals. Those individuals, the Smurfs, are typically low-level participants paid a small fee for each deposit they make, insulating the criminal organization from direct connection to the banking activity. The term entered criminal justice vocabulary during the 1980s when investigators noticed that Colombian cartel money was being deposited in small amounts simultaneously across dozens of Florida bank branches, the pattern resembling the dispersed, coordinated behavior of a certain cartoon character. Banks are now legally required to file suspicious activity reports when they detect structuring patterns regardless of the individual transaction amounts, and anti-money laundering software monitors accounts specifically for the deposit patterns smurfing produces. The method nonetheless remains in widespread use because at sufficient scale, with enough individuals making enough small deposits across enough institutions, the signal disappears into the noise. The casino method. The casino has always occupied a uniquely useful position in the money laundering landscape because it is one of the few environments where large amounts of cash can enter and exit without inheriting the stigma that cash carries almost everywhere else. The classic casino laundering method involves converting illicit cash into casino chips, engaging in minimal actual gambling, and then cashing the chips out as winnings, producing a receipt that documents a legitimate gambling payout as the source of the funds. The casino has effectively served as a cash-to-clean money conversion service. Macau became the global center of casino-based laundering in the 2000s and 2010s, processing an estimated annual gambling revenue that dwarfed Las Vegas, with a significant portion of that money linked to Chinese officials and organized crime figures moving funds out of mainland China in violation of capital controls. Underground junket operators facilitated the movement of billions through a system where mainland clients were extended credit in Macau, repaid those debts in China in cash, and the junket operator deposited clean casino winnings on their behalf, a circular system that moved money across the border while converting it from illicit to apparently legitimate. The United States Department of Justice estimates that billions of dollars move through American casinos annually in suspected laundering activity, despite regulatory requirements that have tightened significantly since the 1990s. The trade-based method. Trade-based money laundering is the method that financial intelligence experts consistently describe as the most under-policed and most difficult to detect, and it operates at a scale that dwarfs most other techniques. It exploits the complexity of international trade. Millions of transactions moving across borders daily, each involving invoices, shipping documents, and payment records that no single authority has the capacity to verify comprehensively. The mechanism involves manipulating the stated value of goods in international transactions to move value across borders while making it appear as ordinary commerce. A criminal organization in Colombia might over-invoice a shipment of electronics to a related company in the United States, billing $10 million for goods worth $1 million, with the $9 million difference representing a transfer of illicit funds disguised as a legitimate trade payment. The reverse works equally well, under-invoicing exports to transfer value in the other direction. Because the transactions involve real goods, real shipping, and real companies, they pass through customs and banking channels with a legitimacy that purely financial transactions lack. The Financial Action Task Force, the international body that coordinates global anti-money laundering policy, estimates that trade-based laundering may account for the single largest volume of laundered money globally, a figure potentially in the trillions annually, while receiving a fraction of the enforcement attention directed at other methods, the cryptocurrency method. Cryptocurrency introduced a genuinely new dimension to money laundering that financial regulators and law enforcement agencies spent years catching up to, and in some respects are still catching up to today. The core appeal is the ability to move value across international borders instantly, without the involvement of any bank or financial institution, with a degree of pseudonymity that makes tracing significantly more difficult than conventional wire transfers. The method typically involves converting illicit cash into cryptocurrency through exchanges with weak identity verification requirements, then moving the funds through a series of wallets and conversion steps designed to break the transaction trail, a process known as chain hopping, before eventually converting back to clean funds through a final exchange or peer-to-peer transaction. Mixing services, also called tumblers, pool cryptocurrency from multiple sources and redistribute equivalent amounts to destination wallets, deliberately obscuring the link between origin and destination. The Silk Road seizure in 2013 demonstrated that cryptocurrency transactions, despite their pseudonymous nature, leave a permanent public record on the blockchain that sophisticated forensic analysis can trace, a capability that has improved dramatically since. Criminal organizations have responded by developing increasingly sophisticated obfuscation techniques, and the technical competition between laundering methods and blockchain forensics is ongoing and unresolved. The loan-back method. The loan-back method is one of the more conceptually elegant money laundering techniques because it converts illicit funds into apparently legitimate income while simultaneously creating a tax-deductible expense, effectively getting paid twice for the same criminal proceeds. The mechanism works as follows. A criminal deposits illicit funds into an offshore account or shell company under their control, then arranges for that entity to extend them a formal loan of the same amount. The loan comes with documentation, interest terms, and a repayment schedule that make it indistinguishable from a legitimate financial transaction. The criminal then repays the loan using further illicit funds, which become deductible interest payments, while the original loan amount sits in their hands as apparently legitimate borrowed capital that can be freely spent or invested. The funds have effectively been transformed from criminal proceeds into a legitimate loan with a paper trail supporting their origin. Pablo Escobar's financial networks used variations of this technique extensively in the 1980s, routing cartel money through Panama and Luxembourg before returning it to Colombia as investment capital. The method requires a cooperative financial institution or sufficiently opaque offshore jurisdiction to function, and regulatory tightening in traditional offshore havens has made it more difficult to execute at the scale it once operated, though not impossible, as the continued existence of jurisdictions with minimal financial transparency demonstrates. The Black Market Peso Exchange. The Black Market Peso Exchange is considered by financial investigators to be one of the most complete and self-contained money laundering systems ever developed, and it emerged directly from the practical problem that Colombian drug cartels faced in the 1980s. They were generating so much American cash that they literally could not physically move it back to Colombia fast enough. The system works through a currency broker who acts as the central node of the entire operation. The cartel sells its American drug proceeds to the broker at a discounted rate, accepting less than face value in exchange for receiving the equivalent in Colombian pesos in Colombia cleanly and immediately, without ever having to move the dollars across the border. The broker then uses those American dollars to purchase goods from American companies on behalf of Colombian importers who want American products but prefer to pay in pesos rather than navigate official foreign exchange channels. The American goods are shipped to Colombia, sold in the legitimate market, and the broker collects pesos that repay his original outlay. The American exporter has received legitimate payment through normal banking channels and has no knowledge of the system they participated in. The drug dollars have been converted into goods, then pesos, without ever crossing a border as currency. The entire cycle converts criminal proceeds into clean commercial transactions with no single participant other than the broker aware of the complete picture. If you made it this far, drop a comment below and let us know what criminal method you want us to explain next. Subscribe so you never miss an upload. There's a lot more where this came from.